Raymond Realty Q1 FY27 Business Update, Strong Demand, Higher Collections or Margin Outlook. Raymond Realty has started FY27 with an impressive operational performance, delivering robust growth in both pre-sales and collections. The update highlights continued strength in residential demand despite the absence of any new project launches during the quarter. The company reported provisional pre-sales of 700 crore rupees in Q1 FY27. Compared to 306 crore rupee in the same quarter last year, this represents an outstanding 129% year-on-year increase. Perhaps the most remarkable aspect of this performance is that it was achieved without launching a single new residential project. This indicates strong underlying demand for the company's existing premium residential developments. Strong sales without fresh launches usually indicate healthy project acceptance and sustained customer confidence. It also reflects the strength of the Raymond Realty brand in the Mumbai metropolitan region. Management attributed this growth to continued momentum across its address by GS portfolio. Better price realization across projects also supported higher booking values during the quarter. Collections remained equally encouraging as the company reported cash collections of 550 crore rupees. This represents a healthy 47% growth over the 374 crore rupee collected during Q1 FY26. Collections are one of the most important indicators in the real estate business. Healthy cash inflows improve liquidity while reducing dependence on external borrowings for project execution. The strong collection performance also demonstrates that customers continue to make timely payments. This supports construction progress and strengthens the company's financial position. Raymond Realty has been expanding aggressively over the past year. FY26 itself was a milestone year with 7 project launches, including 4 major launches during the final quarter. These launches are now beginning to contribute meaningfully to operational performance. As construction progresses, the company expects these projects to unlock significant revenue over the next 12 to 18 months. The company also provided an update on its capital allocation strategy. During the quarter, borrowings of 198 crore rupees were primarily used for construction and working capital requirements. Outstanding borrowings stood at 1097 crore rupee as of June 30, 2026. While this is significantly higher than the previous year, management clarified that it reflects peak construction activity. Importantly, these borrowings are backed by a strong collection pipeline. This reduces financial risk because project cash flows are expected to support future repayments. The company reported liquidity of around 270 crore rupee at the end of the quarter. This resulted in a net debt position of 827 crore rupees. Debt levels naturally increase during the early stages of real estate development. Capital is required before projects begin generating significant revenue through construction-linked milestones. Management emphasized that its balance sheet remains conservative despite the increase in borrowings. The company's net debt to equity ratio continues to remain comfortably below its internal ceiling of 1 time. Maintaining disciplined leverage is particularly important in the real estate industry. Controlled debt levels provide financial flexibility during periods of changing market conditions. Another key point discussed by management relates to profitability. Investors should understand that margins in real estate development fluctuate depending on project stages and accounting recognition. During the launch phase, marketing expenses and initial construction costs are incurred well before substantial revenue is recognized. This naturally creates temporary pressure on reported margins. The company expects margins to gradually normalize as projects progress through construction milestones. Revenue recognition typically accelerates once projects cross specific completion thresholds. Management has reaffirmed its EBITDA margin guidance of 17% to 19% for FY27. This indicates confidence that profitability will improve over the coming quarters despite temporary seasonal fluctuations. For investors, maintaining margin guidance is an important positive signal. It suggests that current operational performance remains fully aligned with management's long-term financial expectations. The Mumbai metropolitan region continues to remain one of India's strongest residential real estate markets. Strong employment growth, infrastructure development and premium housing demand continue supporting property sales. Raymond Realty has increasingly positioned itself within the premium residential segment. Higher realization per unit can support profitability while strengthening brand positioning. The company's ability to generate record pre-sales without launching new projects demonstrates the quality of its existing inventory. This provides encouraging evidence that demand remains healthy even after multiple launches during FY27. Looking ahead, investors should monitor upcoming project launches, construction progress and future collection trends. These factors will determine whether current operational momentum can be sustained. Borrowing levels will also remain an important area to watch. As projects move towards completion and collections continue improving, investors will expect gradual deleveraging over the medium term. Overall, Raymond Realty has entered FY27 with exceptional operational momentum driven by strong customer demand, healthy collections and disciplined financial management. The company's confidence in maintaining its FY27 margin guidance further reinforces management's positive outlook despite temporary seasonality in profitability.